What's good, future millionaires? We back with another banger. I'm DecemberDeMarco, Fortune 500 marketer, here to share my insights of the market with y'all to hopefully help y'all become better informed investors, man. Salute to y'all for pulling up on the channel. Make sure you hit that thumbs up like button for the YouTube algorithm. And also, if you are one of the 49% of the people watching the channel on a continuous day-to-day basis, take a moment to hit that subscribe button. I'm gonna continue dropping content. We just crushed 2021. We about to do it again 2022. Looking forward to making a lot of money with y'all. But this is the type of information that y'all need to be, aware of. This is why it's important to subscribe, because not only do we just look at what's going on in crypto markets, we look at the overall macroeconomic environment. So stock market news live. The stocks have sunk today by the most that they have ever sunk since June 2020. That is a major blow. So if you're wondering why is, crypto pulling back, why do we see Bitcoin back at 28? Why do we see ETH back at 19? Why is SHIB back at that 11 level? This is why. U.S. stocks sank on Wednesday after a series of disappointing quarterly results from some major retailers weighed on the broader markets. Investors also further digested remarks. Matter of fact, let me see if I can zoom in on this for y'all, because I think I just learned how to zoom. There we go. But now it's too wait, I think we still good on here. We should still be good. But US stocks sank on Wednesday after a series of disappointing quarterly results from some major retailers weighed on broader markets. Investors also further digested remarks from the Federal Reserve officials reaffirming their aims of reining in inflation. The S&P 500 slid by 4% in its worst day since June 2020, closing at 3,923.68 cents. The NASDAQ composite dropped by 4.7% to settle at 11,418.15, while the Dow fell by more than 1,100 points, or 3.6%. The moves lower came as some weaker than expected earnings results from retailers underscored the toll that inflation has been having on corporate profits. Target on Wednesday cut its full-year operating income margin outlook as input and transportation costs remain elevated, and estimated it could see an additional $1 billion in transportation costs this year due to rising fuel prices. And this came after Walmart, the largest U.S. retailer, on Tuesday reported weaker than expected quarterly earnings and slashed its profit outlook for the next year, citing higher wages, fuel food costs. Shares of both companies sank, dragging peers including Costco and Dollar General lower in sympathy. So this is what I tell y'all about sympathy stocks. When certain things happen in the market, they can have an effect on similar companies within that industry. And with crypto being, closely attached to the stock market, that's what we're seeing overall. We're seeing, less than each quarter, companies, the previous quarter, they put out expectations, what they, expect to reach in profit, to do in sales, and all these other numbers that they keep track of. And since 22 has been in, we've been getting wrecked. So everybody's numbers is coming in a lot lower than expected, which tells investors that these companies are going to perform a lot worse than expected. So what happens is investors start to sell off. Investors start to cut some of that, basically some of the fat. They start to let go some of those stocks that they're not looking to hold on to, because if it's not going to do good over the next quarter, you might sell it here, wait for it to drop even lower, and then buy in again. So we're seeing a lot of these bigger companies, the Walmarts, Target, and companies like Dollar General and Costco are basically the smaller versions of those companies that will be affected. So, this is letting us know also that this is a good buying opportunity. We're going to continue with this article real quick, but I can tell y'all when this is happening, interest rates are raising, borrowing money is becoming more expensive. So we see less people investing into riskier assets. We're going to see money dry up. A lot of people are going to have to, basically close positions. We see fuel costs rising, so it's basically becoming more expensive to live, to do the everyday thing. So people are going to have less money for investments, and especially riskier investments like crypto. Crypto is a lot more volatile than the stock market. So you're going to see a lot more money shed from, or appear more panic in the crypto markets first. Or not even first, but it just will seem a lot heavier because, everybody's looking at the stock market. If the stock market is doing good, crypto is more likely to do good. But we're seeing the Fed chairman tell us that interest rates have to go up. They have to do that in order to fight inflation, to bring the cost of things down. And in turn, that's drying up all the money. So let's continue with this. It goes on to say the S&P retail ETF dropped more than 8%, in the S&P 500 consumer staples and consumer discretionary sector lagged. I think what investors realized was these seemingly safe haven stocks, the staples like Target, like Walmart, are not immune, meaning they can be affected by this too. And when people see that, they get a little shook up. So that their costs are rising, they cannot pass their higher costs on to the customers. And as Walmart said yesterday, their customers are coming in and buying groceries, but they are not buying hard goods. They're not buying other products where they have a slightly higher margin. Jack Ablin, Crescent Capital Chief Investment Officer, told Yahoo Finance Live Wednesday afternoon. So if you look at the consumer and recognize, yes, wages are up, but they're not going up at the same rate as inflation, and the highest cost increases are food and energy, that's funneling away spending that ordinarily would be spent at a more profitable side of Walmart and Target. That's what I was telling y'all about things becoming more expensive. People are being a little, more conservative or reserved with their spending. So the disappointing results outweighed optimism from earlier this week when investors took in a number of upbeat reports on the U.S. economy. Tuesday, at least short-lived rally came following a couple of solid reports that showed both consumer spending and manufacturing production were holding up strongly. U.S. retailer sales grew at 0.9 rate in April after a sharply upward revised 1.4% monthly rise in March, suggesting consumers were continuing to spend even as consumer prices have climbed at the fastest rate since the 1980s. The latest print on U.S. industrial production also exceeds estimates with a jump of 1.1% last month, or more than double the expected rise. This still strong economic backdrop has given the Federal Reserve more room to raise interest rates and otherwise tight monetary policy to bring down inflation without fear of deeply disrupting growth in other areas like the labor market. So they're saying since people are still, spending and prices are going up, but we're still seeing people spend on the things that they, want the most, we still can, raise rates a little bit, to fight inflation, to kind of scare off some of that spending a little bit. And we're definitely seeing that happen right now. I'm hearing people, in my family, friends, saying how things at the grocery store are becoming more expensive, or just saying how, X amount of dollars used to get you, let's say 2 weeks worth of food or something. Now it only gets you 1 week worth of food. Let me know in the comments. Are y'all noticing inflation yourselves? Are y'all seeing it? I mean, I know we all notice it at the pumps, but are y'all seeing it anywhere else that, a lot of people don't think of? Let me know in the comment section. Fed Chair Powell acknowledged to the Wall Street Journal on Tuesday that while there could be some pain involved in restoring price stability. So if y'all been following the channel, we already talked about this. We already talked about how he said this. He mentioned this maybe like 2 weeks ago, but he restated it again yesterday, which, sent the market, shivering a little bit more. Even though it wasn't, something that we didn't hear, he still kept the number the same, planning on raising it 50 basis points over the next 2 months, June and July. So, nothing changed there, but just to hear those words again, the market can react sometimes to that. So he believed the Fed will be able to sustain a strong labor market. Powell also said that there remain broad support for 2 more 50 basis point interest rate hikes at the Fed next policy setting meetings, reiterating his view from the Fed's last meeting earlier this month. So that's what I was just telling you about. I don't think he said anything that caught us off guard, but let's not forget where we are. Ryan Detrick, LPL Financial Chief Market Strategist, told Yahoo Finance Live on Tuesday, noting that the S&P 500 has fallen for 6 consecutive weeks heading into this week. It hasn't been down 7 weeks in a row for 20 years, y'all. Pay attention to that. It hasn't been down 7 weeks in a row for 20 years. So that's very scary. So our fear and greed index is all the way at a level 9 right now. That means the market is extremely fearful. But as Warren Buffett tells us, when the market is fearful, that is a time when we should be greedy. Now, could the market pull back a little more? Yes, it could, but you can never perfectly time it. Timing the market beats trying to time the market, because trying to time it, you might end up missing what's going on, or you might be, zoomed in too close to be able to look at a bigger picture of what's actually playing out. So, it's best to have that time in the market. So, then you come in today. He said it hasn't been down 7 weeks in a row for 20 years. So we're awfully oversold here. When the market is oversold, that's a buying opportunity. Then you come in today and you've got industrial production pretty solid. You got retail sales pretty solid. Things aren't perfect, but we just think much of the negativity that is priced in is just a little overboard for us. And we think this could be very well an opportunity for some long-term investors here. So that's what I wanted y'all to pay attention to right there. But it has been a wild 48 hours in retail. I think one of the things that really stood out to us was just the common patterns. We're seeing both companies signaling that their stores are seeing stronger traffic versus e-commerce. Both companies are seeing higher costs to execute their businesses. Jefferies analyst Stephanie Wissink told Yahoo Finance on Wednesday, consumers are reshaping their behavior, so moving more towards essentials versus discretion. I think the last thing is that this is not going to abate anytime soon, she added. I think there were a lot of conversations among investors that maybe inflation for the consumer has peaked, but these two companies are giving us very different signals that we're still seeing costs rising faster than the prices and more pricing is to come. U.S. housing starts and building permits each pulled back in April, with rising interest rates and raw material shortages continuing to weigh on the housing market activity. Housing starts fell 0.2% month on month in April to come in at a seasonally adjusted annualized rate of 1.7 million. The e-commerce department said Wednesday this came following a downwardly revised 2.8% drop in March. Single-family housing starts, a closely watched measure of the underlying home building, fell by 7.3% to come in at a rate of 1.1 million. Building permits, which point to future home building activity, dropped by a larger than expected 3.2% in April to come in at a seasonally adjusted annualized rate of 1.8 million. In March, permits had grown by 0.3% or at an annualized rate of 1.8 million. Starts and permits are likely to fall sharply over the next few months, tracking the downshift in new home sales, which in turn follows the ongoing rollover in mortgage applications. Ian said, chief economist at Pantheon Macroeconomics, wrote in a note Wednesday morning, demand likely has not yet hit bottom, allowing for the usual lag between increases in rates and the response from potential home buyers. Let me read that again, y'all. Demand likely has not yet hit bottom, allowing for the usual lag between increases in rates and the response from potential home buyers. So we think sales and starts could easily fall through the end of the summer. Construction has run above the pace implied by the mortgage numbers for the past year and a half, as home builders have exploited the extreme shortage of inventory in the existing home market. But this cannot last much longer. So that's pretty much what I wanted y'all to get updated on. They go on about more things, but that's pretty much the gist of it. Hopefully that information is helpful to y'all. You know, sometimes you got to take a step back and look at what's going on, so that way, you know, you aren't fearful and you don't shake yourself out of the market. But let me know what y'all think about that. That's all we got for this video. We might hop on a live stream later tonight, so stay tuned. Make sure you got your notifications on and subscribe if you enjoy this content. We are out.